Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta, Executive Writer at CTMfile. Joining me today are Jack Large, Editor of CTMfile, and Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome back to the Open Treasury podcast, Jack and Craig. This week we are focusing on 4 themes, namely the cryptocurrency crisis, cybercrime, real-time payment processing and digitization, and finally ESG. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Our first theme for today is about the cryptocurrency sector reeling after the collapse of FTX, a digital currency exchange valued earlier this year at US $32 billion. Last week, when it filed for Chapter 11 bankruptcy protection, FTX indicated that it had more than 100,000 creditors. But in an updated filing, lawyers for the company said there could be more than 1 million creditors in these Chapter 11 cases. It looks increasingly likely that customers and investors who handed their money over to FTX could be left holding the bag, which is why the FTX fallout has rattled investors, raising serious questions about the future of digital assets and the lack of global regulation. According to a Bank of America report published in October 2021, 20 high-profile U.S. corporations that include the likes of PayPal, Walt Disney, JP Morgan, Morgan Stanley, and Walt Disney have some exposure to crypto and digital assets. If I may start with Jack, first, from a treasury and liquidity risk management perspective, how would you assess the cryptocurrency crisis? And second, do you think that the FTX bankruptcy may sound the death knell for crypto, or will the crypto sector bounce back and spur a regulatory crackdown?
To your first question, I think this is symptomatic of the structure of and the risks involved in cryptocurrencies. Any major corporate company, I don't think, would get involved at this stage. In terms of, or should get involved, in terms of regulation, I think this is something that's needed globally, and we need standards globally, because cryptocurrencies are here to stay, there's no doubt about that, but it needs regulating on a global basis, not just on a per country basis.
You know, this FTX situation is, we're fairly early in finding out exactly what on, but it seems like there's certainly quite a bit of, let's just say, value leakage. What caused this? Where did that go? I think we're going to hear more in the coming weeks about what occurred. It's certainly dramatic. This is not some small default. It's massive. The issue of corporate treasuries, they are continuing to, it's maybe less than a toe, but they're dipping their toe in the water to be able to handle crypto as some other customers want to pay for things in that way, or they're trying to gain some experience, but it's very, very cautionary. I think, what Jack is talking about, this is not we want to move all our payments to that, but there's certainly more movement towards that. Everyone, I think, was used to the volatility of some of these cryptocurrencies, but I don't think anybody's ready for these kind of losses or potential fraud. So this is it's not a death knell, but it's another big cautionary tale.
Let's move forward to our second story, which pertains to Australia exploring a ban on ransom payments to cybercriminals. In less than 2 months after experiencing 2 of the largest personal data breaches in Australia's history, the Australian government is looking to bolster its cybersecurity defenses and has said that the government is also considering making ransom payments to cybercriminals illegal. There are multiple ways to decrease the profitability of data breaches for criminal organizations. The first is to make hacks more difficult by increasing fines for companies that fail to adequately train their employees to defend against cyber attacks or follow best practices in cybersecurity. A second potential solution is to ban cyber insurance reimbursements for ransom payments. And the third solution is to make ransomware payments illegal. Craig, from a Treasury perspective, do you think a blanket ban is likely to cause more problems than it fixes?
From a Treasury perspective, I'm not sure. I guess I'll just say from a general perspective, don't give in to terrorist threats, don't pay ransoms. The focus there is that that will dry up the activity. What's gone on though is they've gone from ransom in the $10,000 range to north of 100,000 to sometimes in the multi-millions, hobbling entire companies. And so the payout for an individual company on a decision, to make that decision is far more affordable to do that. That's a decision that makes sense on the individual perspective. On the broader perspective, that funds the criminals who are doing this to do more. And so there is certainly some sense in saying, no, you can't have this type of payout. We're just funding the criminals. But I think it's a lot easier to say when someone else is required not to get their data back or to unlock their servers. That's a much bigger hit for them than if it's your particular situation. So I think it's a challenge. I think it's a hard decision if you're in the midst of it.
Yeah, I think that's absolutely right. It's a hard decision. And even though the Australian government or any other government may say it's illegal, if you want your server back or your data back or to start normal trading again, how much the illegality of this action is going to have an impact, I'm not at all sure. It'll just depend situation by situation. The NHS in the UK were unlocked by a very clever programmer who worked out how the system worked. And that was nothing to do with legality or anything else. It was to do with penetrating the logical way that the fraudsters had attacked the system. The talk about 100 officers being available in Australia to deal with this type of so-called illegal action is fine, but unless they've got the real understanding, I don't see much hope there. I think it's going to be case by case.
Case by case basis. Our next story is about UK-based retail and commercial bank NatWest introducing 3 new APIs to support corporate, commercial, and institutional customer demand for real-time payments and automated reconciliation, including BACS payments. Reports indicate that the new launch will provide commercial clients with the ability to initiate faster payments and international transfers directly with CHAPS, as well as obtain close to real-time payment status notifications. Jack, if you were a corporate treasurer banking with NatWest, would the API launch interest you, and if so, why?
Yes, we're moving collectively. The industry is moving to more real-time, instant payments. The issue is going to be keeping these APIs up to date, because NatWest isn't the only bank that is offering this sort of service. And we're going to see collectively more and more treasurers worrying about how do the APIs are kept up to date. That, I think, is a bigger problem. The individual service at the moment, yes, I think it's attractive, but it's not the only service. The issue is much broader.
Just a couple of comments. One, I could say this is perhaps not much of a story, or it's not much of a story if this were a year and a half from now. And it is an important story. I mean, this is important that the banks continue to offer these faster, easier ways of making connections. So it's showing them building that out and connecting with different technology providers. So there's more opportunities to use this. So it's somewhere in the middle of like the world's biggest story and and a nothing story. It's important movement. It's like a steady trend in this direction. So it's a big deal for NatWest and just solid progress. But I don't think we'll be talking about a story like this in a year or two from now at all.
So I guess it's going to become commonplace.
Well, I hope it becomes commonplace. I mean, it's banks are moving in this direction, and this is a good movement. But the stories will just come more and more regularly. So it'll just move off the headlines.
So the fourth story for today is about Citi's institutional virtual accounts usage increasing significantly with global clients comprising corporations, financial institutions, e-commerce, and insurance companies. This growth comes as multinational companies across industries continue to use Citi solutions to help improve operational efficiency, reduce costs, accelerate time to market, and ramp up their digitization initiatives. According to you, what are the benefits that Citi's virtual accounts offer treasurers over traditional bank account structures?
One of the key things is it's less expensive and it's less confusing to set up in some regards. I mean, every bank account is not a physical box that's stored somewhere. It's digital. It's housed at a certain level in the bank's computers. And so these virtual accounts are just ways that the bank allows their customers to further segment or segregate what goes on, which means you need less of the more expensive accounts. You still only have to protect one external account. You can share more information or more customized information for people making payments. You can break out your flows, which can support accounting or reconciliation or control. It's leveraging some of the technology that's available today to support this activity. Because I think we all have to understand is opening accounts is one of the most challenging things for corporate treasury, one of the biggest headaches for doing that. And it shouldn't be. And the virtual account process is vastly easier. This allows companies to take advantage of the benefits without the headaches of a regular account.
Virtual accounts are a good idea, but they have their limitations. One example of limitation is that you can't do a direct debit on a virtual account. There has to be management of the balance between virtual and real accounts. That's the first point. And the second point is that with the very big corporations, setting up virtual accounts isn't as easy as you think because the money flows could be so big the bank can't cope with them or need notice of them. So virtual accounts are a good idea, but they have to be implemented very slowly and practically, taking into account all the different machinations of the funds flows.
You mentioned the word implementation. From one implementation to the other, which is our next story, which is about the London Stock Exchange Group and Mizuho Financial Group, one of Japan's leading global financial institutions, agreeing to collaborate in providing sustainability solutions to the bank's corporate clients. Jack, are such strategic collaborations between financial institution and a corporation, is this being done to link finance to compliance with ESG norms so that companies can decarbonize to achieve net zero emissions by 2050?
Yes, of course it is. That's the whole purpose. What's interesting about the London Stock Exchange getting together with Mizuho is you're seeing different types of organizations getting together to create the infrastructure to be able to provide more sustainability in the supply chains. The Japanese government's insistence on human rights within supply chains is a good example of what's happening globally, where we're starting to see more and more of these integrated solutions across a whole range of different types of companies and groups to provide sustainability. But the big warning from Qatar is where we're having the World Cup football games is that there's an awful lot of greenwashing going on. We have to be very careful.
Jack, I appreciate your comments. I think these types of organizations getting together to support a market makes sense if there's a market, and there is a market. It makes even more sense if that market's growing. And the market for ESG is growing. It is definitely moving. So this provides more order to it. So, I think this is just a natural extension, an intentional extension of what more companies are doing, maybe in an uneven manner, but it's all moving towards supporting this. And if there's demand, there should be markets for it, and those markets should be orderly. And this is an example of building out on that. So,
can I just add an additional comment? Corporate treasurers are going to have to join more and more of these initiatives. The issue is going to be getting board approval.
Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or most important story of the past week and why. Craig, if I may start with you.
Yeah, I'm going to go with the FTX bankruptcy. Its magnitude is not unparalleled, but it's pretty dramatic of the recent past. And we can think of some of those big stories over the past few decades about what's going on. So understanding what caused that is going to be quite interesting. I think that has an impact not only on crypto, but there's fallout for this wealth destruction that occurred. There's also a lot of other underlying ties to other stories that I think are interesting in the geopolitical environment. So that's my top story on this list.
My top story is actually an amalgam of all the different things that are happening. And it's becoming increasingly clear to me, at least, that board approval for what corporate treasury is getting into is becoming more and more essential. It applies to crypto, it applies to complying with ESG requirements. And what I think is going to have to do more of in corporate treasury is outlining the consequences of their actions. That's going to be a major task going forward.
Those are very valuable insights. Thank you so much, Jack and Craig, for your time and your informative analysis. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.